Today on the Wealth Transfer Podcast, I interview Adam Keller of Three Oaks Advisory Group. He's a financial planner who specializes in helping clients figure out what their goals are and then make investment decisions based on that. Now, one of his niches is helping people who have assets in other countries or live abroad, how they navigate both having assets in multiple countries and then also inheriting or having heirs in foreign countries. It's really interesting. He also has helped a number of women in transition, specifically women who are going through death or divorce of a spouse, because that changes sort of what their investing goals are. And of course, he helps traditional folks like the rest of us who are trying to decide what decisions to make on our investments to make money and also to avoid taxes. I think you're really going to enjoy Adam's candor and wonderful energy. I think he's a great guy to hear from around financial planning. Welcome, Adam Keller. Adam, I'd love to kick us off. Tell us a little bit more about yourself. Tell us your background and how you got into financial planning.
Sure. So native Texan, nomadic Texan, lived all over Texas, ended up at the University of Texas at Austin to finish my undergrad work after transferring around throughout the I-35 corridor. And international business was my focus. So I was blessed with the opportunity to get to go live and work overseas, study overseas, studied in Spain. Spanish was the minor, but got to work in Turkey, Romania, Azerbaijan. So why I studied Spanish, I don't know. But being back in Texas, phenomenal. Anyhow, got to work overseas for a little bit after graduating, and in coming back, had a buddy who's good friends with the hiring manager for American Express Financial Advisors at the time here in Dallas. Went and met with him amidst interviewing for a battery of positions, and it seemed like a phenomenal mix of math plus people and relationships. And that was 2004. So here we are 21 years later, and the rest is history. It's been great. In the meantime, married, have two kids, 16 and 13. Love to be outside, love to hike, love to paddle, love to jump in any body of water. I fancy myself a surfer, but I am freaking horrible at it. Love music. Just got back from a Wu-Tang concert. So for all the, hip hop aficionados out there, but love some 90s country too. So we can mix it up. It's all good.
That's awesome. Well, as a person who invests a lot in real estate and knows a lot about real estate, I often look at financial services and financial planning, and I'm kind of like, how do I tell the difference between these people? And what does the financial services industry do? I mean, obviously, I know that the stock market and these things are really important. How do you describe what you do and how you service clients to someone on the outside?
Yeah, great question. And our industry in general is probably, maybe more divided along the spectrum, or maybe wide in spectrum than other industries. For instance, if you look up financial advisor, you could go to a BMW dealership and the salesperson may have the title financial advisor on their card. So it means a lot of different things to a lot of different people. There are some financial advisors or wealth managers that only deal with investment banking. So companies who want to take their company from being private to public might work with a wealth manager or financial advisor. I don't do that. I have never taken a company public. We work in we call ourselves financial planners. So I'm a certified financial planner, and we joke with clients. That means we're experts in nothing. We just speak a little bit of tax. We speak a little bit of CPA, a little bit of attorney, speak a little bit of real estate, and can communicate well with the client's other professionals to help make sure that whatever choices we're making and advice we're giving is vetted across multiple aspects of the financial services realm, and it's cohesive. I think one of the biggest disservices we get is to give advice in a vacuum and not take into account the way that it may affect a client in other aspects of their financial life. So not all clients want that. Some clients that you work with may be seeking somebody just to help them make trades and invest, and that's okay. And there's some advisors that are set up solely to do that. So I think maybe to answer your question is it really depends on the advisor with whom you're speaking. And so your clients should know what they want from an advisor. And hopefully that helps position them better to vet their options out there, because their options are kind of limitless.
Yeah, that's awesome. So if you had to specifically identify who you believe your best clients are, the people that you can help the most, how do you describe them? What do they look like?
Yeah, great question. I think we always want to gravitate toward monetary figures being drivers and how much revenue does the client bring into the practice. And those things are certainly important, right? If you're working with an advisor, you want to be a significant client to the advisor so they're paying attention to you. And so those metrics are important. And we tend to think about it from the standpoint of a barbell strategy. So we have a lot of our clients who are young professionals, and we say 35 to 55. And then we have a lot of clients who retire, who may be from 60 to 85. And so for the young professionals, we typically want somebody who's got some degree of complexity. So I love getting to work with folks like you in real estate. Maybe the client has 2 to 3 rental properties. Maybe they're getting executive level benefits like stock compensation or deferred compensation plans or restricted stock grants. Those things are phenomenal because if we're going to charge the client a fee, we want there to be topics on which to advise and help the client feel like they're getting value in return for the fee that they pay us. If it's a retired client, we like the complexity that comes from the size of their net worth. So if the liquid net worth is from 2 million to 15 million, that's a really good fit for us. We call that the mass affluent. If you're into the 25, 50, 100 million category, it doesn't mean we can't work with you, but you're probably also being courted by your Goldmans and some of the big wirehouses that just wrap things up in a prettier bow. And we get that. There's space for everybody, abundance. There's 8 million people in the Metroplex. I work with 150, so it's okay.
Totally. What are like when somebody's trying to decide like how to invest their money, what's a good, like, let's say somebody's specifically looking towards retirement, or they're trying to sort of get ready for passing their estate to the next generation. What's a good mix of investments? How should they decide what their investments should look like when they're headed towards retirement or headed towards passing their estate on?
Yeah, good question. And it's so, I wish there were like one rule of thumb answer, but I'll give you an example on the estate and the passing side of stuff. I was just on the phone before this call with a client and their CPA, and we have 3 generation skipping trusts, one for each of their boys. And in the beginning, the generation skipping trusts were being funded, but there were very minimal investments in it that were generating next to nothing in income. And so it wasn't really even a thing to worry about filing the tax returns for them. But now they're sizable enough over 15 years of gifting to them that we're filing separate returns for those. And so when you think about what your proper investment mix is in that, well, the trust isn't really even meant for their boys. It's meant for their grandchildren who aren't on this earth yet. So a more growth oriented mix and something that's not generating a lot of interest or dividends is a way better fit for them than something that's maybe more conservative and kicking off consistent investment income. That may be great for a typical retiree, but this portion of the client's assets are meant to avoid estate tax, not generate a lot of tax today because the client's paying the tax on it. So it really depends on the size of the client's portfolio and what are their other aspects. I think too, like if you are somebody who's worked for the same company for 30 years and you have a pension that will replace 70% of your income, then maybe you can also be aggressive with your investment piece, because if the market crashes in a year, you don't need to take a distribution. You can cover everything that you need with your pension and Social Security and with the rental income that Matt and his team has helped you generate. So
Yeah. Those are some great points. And I guess I knew that, I would think that in my mind, but I hadn't even thought about the fact that, yeah, if this income is not needed for covering your monthly income, you can choose to be more aggressive. Whereas I see a lot of people either in retirement or, and especially in wealth preservation mode, where they maybe don't want to be as aggressive, but you can still have a portion of that portfolio that's aggressive, even if you're headed towards retirement, you're headed towards generational transfer and don't necessarily need it for the income.
Matt, what a great observation. And I think even we tend to tell clients, look, not everybody has to be invested in the markets. For some people, the volatility of the market it causes them to lose sleep. It is more detrimental to them than it is helpful. But what a good position to be in if you're sitting in all CDs right now, which have been paying great, treasuries, a little bit volatile lately. But if you're in a position where everything's in that, and we get a time like we had in April of this year where the stock market drops 16% in a month, what if you just took 2% of your portfolio and bought S&P 500 index funds? They've come back up 20 to 25%. You can sell them right back off and go back into that really conservative mix. But because you're not reliant upon those assets to be available daily, it just puts you in a different position. So again, I think that comes back to understanding how reliant is the client upon the asset, how comfortable are they with volatility, and just how does it fit in with the rest of their portfolio.
Well, I guess that brings me to a very specific question. So if somebody has cash sitting on the sidelines, should they, and they don't need it for their own income or their own, reserves, should they put it in the S&P 500? Is that a great spot to keep it kind of for, I might need this in 6 months or a year or 2 years? Is that a great place to have it?
That's a great question. And I think 6 months, 12 months, 2 years is too short a time to use the S&P 500 as a cash alternative. If it's 3 to 5 years plus, maybe, but we're right back up at historic highs. So that becomes speculative. Like pricing wise, the market's pretty pricey. I was just listening to a podcast from a fellow advisor earlier this week, and he had an observation that in years in which the S&P 500 returns 4% or less, the international markets, so think like an EFA fund, MSCI EFA index, Western Europe, Japan, developed countries, 100% of the time has beat the S&P 500. So I would caution folks of thinking, oh, 6 to 12 months, great time, maybe, maybe not, right? And so if you're going to do that, maybe balance it a little bit, but have a longer time frame. I think 6, 12, even 2 years, 6 to 12 months, even 2 years is a very short time frame in terms of the market.
That's great. That's great. Now, one of the specific niches that you have is working with clients who have assets in international markets or in other countries, or maybe they even reside internationally and they've got US based stuff and foreign stuff, or maybe they've got heirs in other countries. So they're working in both markets. They're working international market and here. What advice do you give to someone who maybe owns assets in the US, but they live somewhere else?
Great question. And it's an area that I love as a former international business major. But it's an area that is super nuanced. So first and foremost, I would say communicate well. Let your advisory team know what your situation consists of. I think about it like going to the doctor, right? If you go to the doctor and you don't tell the doctor the other medications they're taking, and they give you a recommendation that combats something else you're taking unknowingly, it's kind of on you. You got to let them know what's going on. Otherwise, they can't advise you well. And so I think communication is a big part of that, and being open. And then I think it's coordination and understanding, if you have counsel in the foreign country and us here, is there an opportunity to collaborate? So example, we've had clients who've been on assignment in France. And as part of the assignment, they get a tax advisor from one of the big four accounting firms who prepares their returns. And so what happens is we get to jump on calls with that preparer, and they're going to be really familiar with the French system. And so they're going to get to inform us on that. We're going to be really familiar with the US side of things and their holdings here, and be able to go, hey, we noticed that on the French side. If we tweak these 3 levers here, what impact would it have on the French side? Can we lessen the impact there? What's the effective tax rate in France? If it's higher, are there things we can shift here that are taxable in the US but not taxable in France? What about Social Security? Is my client being paid by a US tax roll or payroll, or are they being paid by a French payroll? And are they accumulating service credit in the French equivalent of Social Security? How's that going to work when they go to retire here? So lots of different things, but I think if you have proper counsel in both places, great. If not, we'll try to help you find that, because again, to something we said earlier, CFP's expert in nothing. So we have to engage with other counsel the minute we get international, especially because it's different. And I'm just going to throw a few other examples out there. For filing in the UK, we had a client sell a property last year. Well, the husband and the wife each had a percent ownership in the property. In the UK, each spouse files taxes separately. In the US, you can do married filing jointly. So there's different strategies on how you attack that in the UK than how you attack them here. And their capital gains rates are different. So it's important understanding that too, and the credits that you get for paying capital gains tax, how they affect your capital gains tax here. Fun, nuance, lots of opportunities for advising.
And so one of the things that we obviously tackle on this show is wealth transfer. What are some of the complexities or issues you see with passing assets to the next generation when you either live in another country or have mixed assets?
Yeah, sometimes it's either the most simple thing, which is just logistically, do those heirs in the other country know where your assets are here? So, Matt, you probably deal with this a lot where when you're working with an heir, they may not even know that the deceased actually had property in multiple states. Well, think about how much harder that is when the heir speaks a different language and uses a different banking system, whatever else it may be, right? So I think making sure that if you are a person who's got heirs in another country, give them a roadmap. Let them know these are the institutions with which my accounts are held. Here's the way that they're titled. Here's the advisors I work with, right? And then understanding what your U.S. tax status is. If you are a U.S. citizen or a permanent resident, you have close to a 14 million estate tax exemption this year. If you are a non-resident alien, it's closer to 60,000. So if you don't plan properly and you're a non-resident alien here with U.S. situs assets, they could be taxed at 40% on anything above 60K. That's pretty scary. That's probably not your goal to give a bunch of money to the U.S. government.
On a side note, some of our clients have started using software. Like there's one called Trustworthy. I think it's trustworthy.com. And it's like keep track of all of your different asset locations and bank accounts and other things all in a secure portal. You can even do multi-generational portals. So like, certain people have certain access to certain things, et cetera. You can bring the financial advisors and the CPAs in to be able to insert data or extract data. Because I do think oftentimes I see this all the time. People pass away unexpectedly. And then the heirs spend all this time trying to sort through where's this at and who owns this and what, oh, now we know about this thing, or oh, there's this notice of this bill that's needing to be paid and I don't even know about this. And so trying to get all, and a lot of times I think I was criticized by a colleague recently. They're like, think about how much you as a young person don't have organized because you're not thinking about death. And many times we do see people pass unexpectedly and they weren't necessarily as prepared as they want to be. So it's never too early to start putting those things together and at least have a roadmap. And then you just add to the roadmap, as it gets more complex. And as people become more wealthy, life becomes more complex. And it's like, at that point, it becomes almost a multi-month, multi-year process of sophistication and cleaning up and documenting. So I do think even finding some of those technologies that might help them to, I for a while called it the death book. Like, how do I make my death book so that it's easy? I can, like, someone can go in my office and find all the logins and all of the info they need. And one of those resources some of our clients are using is trustworthy.com. Now, so we talked a little bit about some of the complexities of transferring assets, and also obviously you work with international clients and that's one of your niches. Another thing I've noticed in the financial services industry, and I heard this as a recent stat, that many times we're seeing women become widows at earlier ages. We're also seeing divorces, and many times these estates are much bigger than they used to be. And a big area of development in financial services is serving women who are now single, whether from death or divorce, and they're making different decisions with their portfolio than maybe they did when they were married. And so there's this whole new industry for serving wealthy women in transition. Are you guys seeing a lot of that? What are you seeing in that space?
We definitely do. And we have the benefit within our partnership of having an advisor or partner up in the Bay Area who is a certified divorce financial analyst. And so that's his bread and butter. He works in that realm often, but we do see that. And there's some specific things that we've run into in the past years that I think are interesting, some of which pertain to real estate. So for instance, we had a couple client go through divorce in the Midwest, and we had a mortgage that had been refinanced in the eras of sub 3% 30-year notes. Well, when you're going through a divorce and you're separating assets and potentially one spouse is getting the house, what do you do with that? And can you assume the mortgage? And that's like one of the first things we look at and go, hey, let's not look to pay that mortgage off. Let's look to see if we can assume it, get the other spouse's name off of it. And there's some fees that are associated with that, but most lenders will work with clients on that and keep that asset intact, because cash flow is obviously impacted when we go from two incomes to one. But most often in those situations, for that spouse to go out and find comparable housing, the cost would be double to go get their own place rather than maintain the existing one. And so I think we want to be cognizant of that. I think in particular for spouses who've gone through the loss of a spouse, we've seen it happen, and we get life insurance proceeds that come in. And a lot of times the thought is, gosh, let me pay down any outstanding debt. Let me clear those things out. But again, if we have a mortgage that's at 2.8%, Marcus online savings accounts are paying 3.65%. What if we just bank those proceeds in that, and you get 3.65, the mortgage is paying at 2.85, you win all day on that, right? And so just helping the spouse make smart decisions on how do we deal with this shift in two incomes to one. Those kind of things are big, and very often, and it's not even gender specific, one spouse in the relationship takes care of all the financials. So if the spouse with whom we're working is the one that happens to not be the one that deals with the finances, it's scary. And part of it is, who do you trust, and are they working in my best interest, etc. So I think part of that is also just for those women in transition in particular, making sure that they're comfortable with whom they're speaking, and sometimes they're not comfortable with another man in the process of what they're going through. So phenomenal females in the space, we have a lot in the industry that we know, and if anybody's ever running into that and they would prefer a female advisor, we've got some great ones we can refer as well. So
Yeah. And we're, another thing that we're even seeing, or another thing that I tell people when they're going through, or, after maybe a few months removed from the grieving process of losing a spouse, if you live in a community property state, you get this benefit of the step up in basis on your assets. And so a lot of people don't realize they've maybe been holding on to an asset because they're worried about the tax consequences, but now they've basically got this open opportunity to sell off assets and not have to pay the capital gains tax from the step up. And of course, that's going to have some variability depending on the size of the estate and those sorts of things. But assuming that they've also got some counsel around estate taxes from a capital gains perspective, close to the time of, or within the year of someone passing away, as long as the values haven't changed significantly, there's minimal tax consequences to selling those assets. And so we always say, like, let's rethink our whole strategy. Was there anything you're holding on to because you're trying to avoid taxes? By the way, I think I talk about step up in basis almost every time I do an episode, because to me, it's just like one of those things people just, I think most people never heard that phrase unless you're in an industry where we use that or we talk about tax consequences. But the idea that the calculation that the IRS uses to decide whether you pay tax or not, the baseline goes up when you have a death in a marriage, because it's community property. Community property states, that's a big opportunity. So I guess the other thing that I'm trying to understand for helping clients is, when let's say somebody has not generally had a financial advisor, they've not had a financial planner, but they've been getting advice from a number of different places. Is there any other advice you'd give to somebody who maybe is starting to accrue more assets and they've never selected a financial advisor or planner before? How would they go about deciding who's the right fit for them?
yeah, it's funny. Maybe I'll use one of the questions that I ask a prospective client in a new client meeting, which is, if we work together and you hire me and you engage me in a planning relationship and pay me a fee, and we sit across the table a year from now, what do you want to see in that year to consider it a successful year of working together? Defining that really sets good expectations, and I think helps the prospective client understand and voice what it is they want, and helps the professional understand whether or not they fit in the realm of what those expectations are asking. So I think maybe one of the first things is, you haven't been using an advisor, you're going to use an advisor. What changed? What's the impetus? Do we not have as much time to dedicate as we did before? Are we realizing that we've done all the basics and now we're out kicking our coverage? We need to go bring in a professional who maybe knows 201, 301, 401 level things. What's the driver? And I think if they can understand the value that they're looking for, it probably is easier for them to sift through the advisors out there in terms of what they're offering and whether or not they're a good fit for them. Some other things to ask: it's always good to understand, how does the advisor get paid, right? There aren't very many nonprofit financial advisors out there. I haven't met one yet. Perhaps they exist. But understanding how your advisor gets paid, and that should be super transparent. I will admit that even in our practice, it's not always super simple. Sometimes it's a hybrid between a quarterly or flat fee and an assets under management fee, meaning if I'm managing a $500,000 account for you and I'm charging you 1% on that, that's $5,000 a year in revenue for me. So, but either way, it should be a conversation that the advisor is comfortable broaching with the prospective client. And if there's blocking or hesitancy, that should be a little bit of a red flag there. I think that's important, right? When I go to the mechanic to take my car in, I would rather not be super surprised. Sometimes we're going to be because as they get in to fix one thing, other issues come up. But I would rather have expectations up front how much I'm going to pay.
What are some of the major issues you see in the client financial planner relationship?
Yeah, I think the expectation on what working with an advisor or investing alongside of an advisor means. And I think in most clients' heads, they think I started here, my journey is going to be always up and to the right, and I'm always going to be positive returns. Look, if I could guarantee that, all the clients in the world would be mine. I can't. The markets are going to dictate some of those movements, and we have some cool techniques that we think are helpful in mitigating risk. But I think that's probably one of the biggest ones is just understanding how investments work, and part of that is patience on the side of the advisor, too. Number one, hopefully we're doing our job and monitoring things well. But number two, communicating well so that when the markets are scary and volatile, we should be reaching out to the clients too and helping to gauge how are they feeling, what are they thinking, and enabling them a platform in which to talk through things. And hopefully, like, we get to earn our stripes in those times and help you make wise decisions on what to do. And ideally, we've planned in advance to say if and when this happens, because it'll happen again. How are we positioned to deal with that? So I think maybe that's a big one. I think often too, I think about it, we just did a webinar with CPAs. And a lot of times clients are going to want to come in and they want to go, hey, I want my tax return to give me as much back as I can, but also no red flags to the IRS and no audit issues, right? And it's like, well, sometimes those things are indirectly related, right? And I think it's the same with investment portfolios. They're like, hey, I don't want to take on any risk, but I need to get 10% a year. That doesn't really exist. So I think just even setting proper expectations on growth expectations is important. Those are probably the biggest things. I don't know that we run into too many other rubs out there, but maybe one of the things that separates us from other groups is our ability to be collaborative. I think a lot of times clients come in and expect, oh, they're going to help me with my 401k plan and they're going to help me with this money that I've inherited. Those things are expected. I think what they don't see as often maybe is us going, hey, I actually need copies of your tax returns and your pay stubs. And we want to start projecting now in June, July, and August what 2025 taxes are going to look like. We'll prepare it. Then we want to be in touch with your CPA. And we want to share with him or her what we're doing and get their input and come back. And then we want to get on your benefits profile. And we want to log in and we may change contribution rates to a 401k or elect different medical insurance coverage or contribute to an HSA. And I think maybe sometimes that expectation of the degree to which we collaborate and work across different areas isn't expected. But by the clients that we love working with, it's appreciated, right? It's a holistic picture.
Now, one of the big topics that we hear around wealth transfer that gets brought up all the time is legacy or legacy planning, and it almost becomes a buzzword, but obviously the heart of it is across a lot of wealthy people, which is what am I doing either for the next generation or the next number of generations? What am I doing to leave an impact on the world? How do you help your clients think about legacy for those that are in the position to do something for future generations?
Yeah, that's a really good question. And again, I think it really is dependent upon a client's level of net worth, but it's not just that. And I think where we start is asking the client what legacy means to them and what are their goals when they're no longer here? Where should assets go? What are their thoughts? Anything that they've seen within their own families that they want to avoid. And so it's funny, Matt, you mentioned earlier step up in basis, which I think we love as professionals to use. We also love the idea of avoiding estate tax. Well, the reality is, since the estate tax exemption level is so high, very few Americans pay estate tax. And so there's like when I started in the business, the estate tax threshold was 600,000. We created estate tax issues for every client that we sold $1 million term policy to. Every single one, estate tax issue. So I think it's understanding what's important to them, and it's very rarely estate tax is their number one priority to avoid. But sometimes they want to leave behind a bigger amount than maybe they have in liquid assets, and we get to come back and have the conversation and go, tell us about your relationship with your children. And the legacy doesn't always have a dollar sign tied to it. All the beautiful time you spent with your kids, you helped educate them, you did family vacations. Like your legacy is beyond the monetary side. And then as we get into the monetary side, Matt, you mentioned some really cool things like the tax benefits of a step up in basis. So sometimes we may be thinking, hey, are we not using these IRAs? If we're not using them and we're not filling up our lower tax brackets, like the 10, the 12, the 22% bracket, maybe we could be converting some of these IRA dollars into Roth. You, Mr. and Mrs. Klein, are going to pay the taxes on that today. We don't like that. But historically, it's lower than what you paid while you were working and you were in a 35% tax bracket. So you win there. And for your children, when they get a Roth IRA, the growth is tax free. That's pretty cool. So those things are helpful. I think if they have charitable inclinations, helping remind them you don't always have to just give cash. Cash is probably the least tax effective asset to give to a charity because you've already paid all the tax money out of it. So I would rather you gift appreciated ExxonMobil stock that you paid $10 for. Now it's at $100 a share. Gift that. And you don't ever have to pay capital gains tax on that $90 gain. The charity doesn't have to pay capital gains tax on it. That's cool. Always talk to your tax advisor. We can't give tax advice, just tax planning. Donor advised funds have been extremely popular over the last 5 years. I think, especially in light of the fact that our standard deduction is so high with the Tax Cuts and Job Act of 2016 that's set to sunset this year. Keep an eye out on that. The big, beautiful bill that's going on right now to potentially address that. But it's harder to do bunching strategies that we used to do, right? Where we would put 2 years worth of charitable contributions into 1 year, January and December, and then do none the next year. Well, the standard deduction is so much higher. So it may take a much bigger charitable donation when clients no longer have mortgage interest and those kind of things that they can write off to get above that. And the donor advised fund is a great way to do it. So that's something that we've considered a lot.
Well, and I love that you brought up some great strategies. I know another one is donating straight from your IRA, right? So you get the tax benefit if you donate straight from the IRA versus taking the draw out and then giving a donation, and maybe you don't hit that standard deduction, but you can still get that benefit. And the other one that you mentioned was the IRA rollover to the Roth IRA. And I'm not a financial advisor. I just love paying attention to this stuff. I know that if you inherit an IRA, you have 10 years to receive all that. How long do you have on the Roth?
Perpetuity, right? So
I think, yeah. I thought that it's inherited and then it can just keep growing, right? Tax free, and then make distributions. So yeah, it's super cool from that perspective.
And it's always good to look at that too, because while there's no required minimum distribution tied to it, as a non-spousal inheritor, sometimes the time frames do start to shift, and Secure Act and Secure Act 2.0 start to address and change a little bit of that. So I will say that even I that love to hang out in the tax planning space, I need to go review the rules on that, because it's funny, like where our clients are, we haven't seen a really big shift of wealth in the Roth side of stuff the way that we have experienced it on the traditional side of stuff. So we've seen the 10-year rule come into play for clients who passed after December 31st, 2020, I think it was, they're subject to that 10-year withdrawal rule on the IRAs. We have like maybe out of 300 clients we serve between David and Philip and I here, maybe 3 clients who have inherited Roths. Inherited IRAs, I can't count. There's a lot.
Yeah, for sure. And then the other thing that I want to circle back to, and it goes outside the money space, but it goes back into that legacy space. One of the things one of our recent guests was talking about was how many families he's seen in the ultra wealthy space where 2 or 3 generations later, they've got all the money. They've got their trusts are perfect, are well funded, and they don't even have jobs, right? He's like, of David Johnson, who we recently had a podcast with, he said of the 30 heirs in this one scenario, 29 of them did not have jobs. And so then you think like, wow, is that actually creating a quality of life for these people to then not have meaningful work, which is a thing I really care about. And so I think too, like, well, when you think about wealth transfer, it does have to eventually go beyond the money, because you can actually probably in your lifetime create enough wealth to then transfer to multiple generations. If you really strive at it, if you really plan well, if you really think through these things. But then the real wealth transfer is, how do I take my values and transfer them to my kids, but then to my grandkids? And how would I instill them into my family in such a way that they are self-perpetuating so that they last into generations in the future? How would I create a family legacy of our values and our virtues that then goes beyond 1, 2, 3 generations? And I think that's something to not lose track of. Like, we can get almost caught up in the money transfer, and it is almost its own double-edged sword where, yeah, you want to make sure that future generations are cared for. And then you find out, actually, if you were able to look into the future, you find out actually that your family was harmed by too much wealth transfer, right? And I look at even Bill Gates, who said, I think he said each of his kids are going to only get $10 million, right? Which is still $10 million is probably plenty, right? You'll probably be fine, and they probably won't have to work. But it's almost like, even if it's whatever the numbers are, it's almost like the values and virtues transfer is more valuable than whatever the dollar figure is.
I would agree with that completely. And it's funny, right? Because I think we can relate that same concept even to retirement, right? And think about, you may not have seen, if you've worked all your life, you may not have seen the detrimental effects of all that wealth on your next generation. But what you may see yourself is when you no longer work, if you tie so much of your sense of self to the work that you do, the accomplishment side of it, you start to feel a little bit lost in those first few years of retirement. And so you might be able to see a little bit of what could potentially happen if your children, grandchildren, great grandchildren never have a need to work. That robs them of the ability to shape out one aspect of who they are or utilize the gifts that they've been blessed with to share with others. And so you make a really valid point. And I think what we try to remember as stewards and servants of our clients is it's understanding what's important to them and their goals, and sometimes giving advice and warnings, but also, helping them shape what does that look like.
Well, this has been a really fun time discussing some of these things. There's obviously probably hours more we could talk about this, but I'd love for you to tell the audience how they can either get in contact with you or where they can find more information about your specific services and how they might be able to get more info.
Yeah, and Matt, hopefully we can share contact information. My email address is akeller, Keller, at 3oaksag.com. Really long domain. It's all spelled out. I'll get all that over to Matt so he can post it alongside any of these materials. They're welcome to go to our website, 3oaksag, as in advisorygroup.com, and you'll find bios on there. Click on our different team members. You can find out a little bit more about who we are there as well.
Is there anything else that you want to tell the audience, or any final thoughts or stories that you want to share?
Yeah, I think just the idea in general that as Americans, maybe we put a lot of weight on our shoulders and a lot of self-imposed stress thinking about our net worth. Is it adequate? Am I leaving behind enough? Am I doing enough to build? I think the key is we want to be good stewards of the wealth and the resources that we've got, but we don't want to be so driven by them that we're stressing ourselves on hitting only monetary milestones. So my hope is that the audience gives themselves a little bit of a break. Make sure your T's are crossed, your I's are dotted, be good stewards and don't be negligent, but get out and live, right? Wealth is great, but if you don't enjoy it, what's the point?
That's awesome. Well, Adam, thanks for being on. That's it for today's episode of the Wealth Transfer Podcast. If you found value in this conversation, would you leave us a review? That would be just so honoring to us. We'd appreciate it. And if you know somebody who might need to listen to this because they're thinking about their next chapter, will you send them a link to this podcast or this video so that they can listen more as well? For more episodes and expert insights, be sure to follow and subscribe. That means the most to us. Follow and subscribe, please, please, please. And when you're ready to take action on your own real estate plan, or if you need help with wealth transfer planning, we know a number of experts in all the different spaces. We'd love to connect you with them. You can reach out to us via direct message or comment. You can email us, matt@templeton.realestate. No .com, just templeton.realestate. And I'd be happy to connect you with an advisor. Thanks so much.